So here's what I want to give you guys. So if you saw the show this morning that I did with Tom and Tony, the skinny on options abstract application, we talked about probabilities being objective in nature. We talked about how the market is so interesting in that, all these opinions flood the market. All these opinions come into, the market via the order flow that comes through the pipes, and they're all subjective at some level. Right? It's all based on different opinions. It's all based on different, algorithmic code that some human is writing. I mean, I know ChatGPT is writing at least 20% of the code now. And so we're shortly not going to be in a state where humans are even writing code anymore. But for right now, we have some amount of subjectivity left. Well, at the end, though, once you go through the various stages that we talked about this morning with option pricing models and expected moves and all those things, you end up with objective probability. So you end up with an objective metric in the end that you can say, all right, this is not really based on, one person's bias, one person's, subjective view. They view things, bullishly. They view things, bearishly, whatever. This is going to be the amalgamation of all the different opinions that are in the marketplace, making the prices very efficient, giving us some form of equilibrium. And so you have objective probability. Well, I kind of wanted to show you guys here today on my show. I'm like, how can we take that information and how can we build a trade? Like, how can I take that information and how can I kind of create just a very simple little 3-step process to utilize those probabilities in a way that gives me a trade idea? And so that's what I want to talk about here today. So Ryan, I'm going to bring us into the content and then we'll do this trade in the portfolio in just a couple of seconds here. So probability analysis on trade entry. So Ryan, go ahead and take us right into the one and only slide today. Let's do it. All right. So we kind of mixed it up on the slide a little bit. Went text heavy just to kind of keep you guys guessing out there. Using the objective metrics in the marketplace, we can create a repeatable process for setting up positions at trade entry. Now, you can see first, second, third. I'm going to make this really simple. I'm going to make this super, super simple. There could be additional steps that you could add. Right? There could be an altogether different list that you might use. This is not intended to be an exhaustive list of all the steps that you should use for every single trade idea or every single hypothesis you have in the marketplace. However, is it a good starting point? I think so. Is it a reasonably simple way to view building a trade idea from, start to finish? I think so. I think this could be a really good framework that you could use if you're looking for something as a bit of a foundation. If you're looking for something like, hey, I need to kind of figure out like how to start putting trades on. If you have a neutral bias in the marketplace, right? For those of you that have skipped down to the green box, my overachievers out there, this is going to be best suited what I've created for us today for neutral strategies. So like a short strangle, like an iron condor. It could even work for a straddle. It can even work for an iron fly. You could use this for a number of different neutral strategies, but short strangle, iron condor are probably going to be the two most popular ones that we would use. Number one, here's what you do first. And I'm going to do all this in the portfolio in just a second. We're going to pick an underlying and we're going to do this in just a second. Number one, if you're looking for a short premium trade, you want to scan the tastytrade watch lists. And again, I've talked about this before, but you're going to see I'm going to use the Tasty default watch list or Tom's watch list. Those are my two favorite watch lists that I like to use. Short premium position, I scan the tastytrade watch lists and I'm looking for high implied volatility rank opportunities. So I scan by implied volatility rank from high to low. That makes my job so much easier. That makes all the steps that follow so much easier, so much simpler, so much more efficient. That this is just a really, really, really good way to start this process. All right, that's step one. Step number two, this is where we start to bring the probabilities into the mix. Let's anchor our strikes on the expected move to establish a high probability base for your trade. So I go to the trade page. Again, we're going to see this in just a second. I go to the trade page, right? I pick my expiration cycle. Then I anchor my two short strikes right at that expected move. Now, I may stay there if I'm going to do a strangle. I may add wings if I'm going to do an iron condor, whatever. But that's just a really, really good starting point. But again, once you get used to doing this, these two steps alone will take you, maybe a minute and a half at the most. Like you scan, you find high IVR, you like the underlying, boom, you click it, you're in the trade page, within 5 seconds, right? So it's so quick, it's so seamless. This is just a really good way to be thinking about high probability opportunities and establishing high probability opportunities. Number three, and this is where it starts to take a little bit of tweaking, a little bit of polishing. Fine tune the strikes to achieve the pop credit balance on the position that you are looking for. I've talked about this a million times on the show before, but I think it's maybe been a minute since we brought this up. You always have to give some probability up in exchange for some credit collected. You always have to make that exchange. You always have to make that trade. It's almost like for every gimme, there's a gotcha. If you want high probability, you have to be willing to accept lower credit. But if you're willing to give up a little bit of that probability, you can usually, and by usually I mean always, achieve a higher credit on that position. And so this is the three-step process that we're going to follow to build this trade. And so let's go ahead. Let's do it. So Brian, go ahead and take us back into the portfolio now. Let's start. We'll do 1, 2, 3. We'll go watch list. We'll go expected move. And then we'll go, what's the third step? Fine tuning. That's your third step. NASDAQ's back to unchased. Man, I was concerned there for a second. We're back to green. Don't you worry about it. So let me minimize up AMD, AMZN, and DIA. All right, so let's go in here. Let's click on our little hamburger menu right here. So you can see that I have the Tasty default watch list queued up. And I already have the implied volatility rank. So this column right here, I already have this guy sorted from high to low. It's almost like I was preparing for the show. Right? Like it's almost like I'm like, man, let me take a look at this before the show so that I kind of know what I'm doing. But if this isn't the case for you, where it's not already sorted, all you have to do is click on it. So if you click on it, right, if you click on it once, I think it sorts by maybe name, or yeah, it sorts in alphabetical order. So the clicks are, one of the clicks is going to get you alphabetical order. The next click is going to get you low to high IV rank. The next click is going to get you high to low IV rank. Now, again, I'm looking for a short premium trade, so I'm interested in high to low. I'm not interested in low to high. I want high to low. I want top-down analysis when it comes to IV rank. Okay. Looking at the list, my eyes are immediately drawn to GLD, right? GLD, the gold index. I don't have a position on the gold index. It's obviously in play right now. You have an IV rank of over 43. It's like, all right, I don't have to, get mixed up in, the individual stock risk of an individual stock position, which is of course perfectly fine. And we do that all the time, but it's like, well, there's a lot of advantages to just focusing on indexes if that's just what you want to do for a given trade or a given season of your year or whatever it might be. Your GLDs, your IWMs, your SPYs, your QQQs, your TLTs, like these indexes are so advantageous in so many ways that usually when I find high IVR in the indexes, I'm pretty much set. I'm pretty much ready to go. Now, don't get me wrong. I'll mix it up in an apple. I'll mix it up in a snowflake. Like I'll mix it up with a little Florida. We haven't done a Florida trade in a while, by the way. But if I see what I'm looking for in an index, I'm almost always going to choose that index. So when I look at this list here, I see GLD being very high on the list. I'm like, all right, let's choose GLD. So boom, done. GLD, done. That took us, 2 minutes? And that's 2 minutes with, a minute 45 of my commentary. Right, so that's 15 seconds of actionable, movement in terms of finding what we're looking for. So we've got GLD. Click on that. We go to the trade page, and I'm going to choose my June 16th cycle. So this guy has 39 days to go. So it's really close to 45 days. I'm not going to choose May 19th. Obviously, that's only 11 days away. That wouldn't really make a lot of sense. I also don't really want to choose July at this point. I mean, July right now is 74 days away. So that's basically, like kind of a long-term, like retirement type of option. So I'm kind of thinking June 16th, 39 days to go is what we're going to choose. So boom, there you go. We're in the cycle that we want. Now look at the copper strip. There we go. Look at the copper strip right here. So we have this copper strip. Let me box it off. There's your expected move. Like that's it. It's right there. It's right on the page. It's all, and that expected move, as we established this morning on the skinny with Tom and Tony. You look at order flow, you look at option prices. You compute implied volatility, and then you're able to set expected moves. That's effectively what the market is doing in real time all day long. That's kind of what the numbers and the metrics and the stats that the pricing models are churning out for us all day long, every day, simultaneously. Like these things are constantly moving and they're changing to respond to market conditions for us. And so now what I'm going to do is, just to make it really simple, I'm just going to sell the strike right on the edge of the expected move, or you could go a little bit outside the expected move if you want. It doesn't matter that you get it perfect right now because we're going to fine tune this anyway. And so if I select, the 180 put, that's going to be my downside. You can see right there, if I leave it centered on the screen there, boom, I've got my downside strike selected. Now let me go to the top side And I'm thinking, let's do like a 196. So if I start right here, you can see that this is a short triangle for $3, a $3 credit. My pop is 66%. My P50 is 80%. Right now, think about the probabilities. Think about expected moves. Think about what they represent, right? Usually, they're going to map to right around a plus or minus 1 standard deviation range, right? And we know from a normal distribution, that should come out to be around 67, 68%. Well, look at the probability of profit, 66%. It's almost like these things are connected, man. It's almost like these things are kind of interdependent in some way. And so everything is kind of checking out. Like everything is checking out. The probabilities make sense. The NASDAQ's back to being up 20, like all is well in the world, right? And so everything is beginning to kind of come to fruition the way that I would expect it to come to fruition. Now, for me personally, right here, because of my account size, like 20,000-ish, I can't leave this in its undefined risk form. Now, if you had more capital than me, if you had 50, 60 grand, you could easily do this trade if you like the way that this sets up. And you could keep it undefined risk and you could collect a greater credit. You could have higher probabilities. You can do all the things that are available to you with undefined risk trades. But for me, if you look at this buying power over here, at about 3 grand, that's going to be way, way, way too much for me and for my account. And so because of that, I am going to look to buy the wings. I'm going to look to create my favorite strategy, which is the iron condor. And by the way, for those of you that are new to the program, that was sarcasm. The iron condor is not my favorite strategy. I have to be honest with you all. But still, I want to be open, right? I want to be strategically diversified. And so even if there are strategies that I don't necessarily love, I'm still going to mix them in from time to time. So now we've got our short strike set. What I'm going to do now is I am going to delete these boxes. I want to buy probably some $5 wings. So if I buy the 175 on the downside, and then I go to the top side, and you can see that the 196, I can't buy a $5 wing because there's no 201 strike. Right? Like you can see the 201 strike is gone. I have to go 200 or I have to go 205. I don't really want an unbalanced iron condor. I don't really want, to have kind of asymmetry with the wings on the two sides there. So what I'm going to do is I'm just going to move my 196 strike up to 195. And then that creates a little bit of space for me so that I can buy this 200 wing. And so now this is how my iron condor starts. $5 wide iron condor, probability of profit 57%. So that's actually quite good. The probability of collecting 50% at some point over the life of the trade is 73%. That's also really good. But I'm only collecting $1.58. Now, this is what I meant when I said, step 3, fine tune your strike selection so that you can achieve the pop credit balance that you want. Now, you could do that with the undefined risk trade version that we just had up there a second ago, of course. But for me right now, I'm just going to focus on this because this is the one that I think I'm going to do. When it comes to the pop credit trade-off, I'm looking at this and I'm like, all right, the pop at 57%, it's obviously not super high, but when it comes to iron condors, you have to make sure that you process all, pieces of information contextually. Like 57% in isolation is not that high. 57% for an iron condor is like super high. Like it might as well be 85%. It might as well be 88%. Usually iron condors, your pops are going to be around 50-50. The pop itself. I'm more interested in the P50, not really the pop. And so the pop is not as relevant as a P50 when it comes to, this specific strategy, if not most of the strategies that we do, to be honest with you all. And so what I'm going to do is I'm going to start moving these strikes in a little bit until I'm able to beef that credit up, because $1.50 on a $5 wide spread is not enough, in my opinion. I need to be at least at $1.70. I'd like to be closer to $2. So I'm going to see how far do I have to move these strikes in to get close to $2, and then what does the trade look like when I do that? So I'm going to move my top strikes from a 195 200 to 193 198. So by doing that, you can see we've tightened this up, obviously. We're inside the expected move now, but that's kind of the cost of doing business when it comes to an iron condor. Pop is 53, so it's getting close to that 50-50 marker. But look at what has happened in my credit. I've picked up another 30 cents or 25 cents of credit collected. Now let me go to the put side and let me do the same thing. Let me just tighten this up a little bit. Let's go 2 strikes. And man, it's almost like I looked at this earlier today. Like it's almost like we've done this before, right? So now look at this. We're at a 177. 182, 193, 198. Gold sitting at 187, almost 188. Right, we're in the June cycle with 39 days to go. My pop is 49%. So it's right there at 50-50. That's what I would expect. My P50 is 61%. That's a lot more attractive, a lot more favorable for obvious reasons. But look at my credit collected. Now I'm at 206. 206. So I've beefed up my credit collected by 50 cents. Not only does that give me more profit potential, but it takes some risk off the table. That's a gimme. Where's the gotcha? Well, you saw my probabilities have gone down significantly. Right, my probability went down from 57 or 58 when it was the first strikes that we selected, all the way down now to 49. Right, and then of course, when you compare this up against its undefined risk counterpart, this is a huge drop off from what we saw with the short strangle. And again, that's kind of a categorical difference between undefined risk and defined risk. But when it comes to probability analysis at trade entry, I think this is, a reasonable way to go about it. Kind of setting up trades from start to finish. So let me go ahead and let me get this filled really quick. 206. Yeah, we'll probably have to give up a couple pennies, and then we can get to y'all's questions. All right, filled at 204. Man, there you go. We're in our GLD Iron Condor